Question 1. The risk matrix shows a moderate increase in the likelihood of regulatory scrutiny for Next PLC's customer onboarding process due to a new digital payment integration. Considering the UK regulatory framework, which approach best balances the need for efficient customer acquisition with robust compliance. Option A. Expedite the onboarding process by reducing the number of identity verification steps for all new customers to speed up transaction times. Option B. Rely solely on the new digital payment provider's existing customer verification protocols without conducting any independent checks. Option C. Introduce a manual review of every single customer onboarding application, regardless of risk, to ensure absolute certainty. Option D. Implement enhanced but automated identity verification checks for all new customers, with a flagged escalation to a dedicated compliance team for any anomalies detected by the system. The correct answer is D. Implement enhanced but automated identity verification checks for all new customers, with a flagged escalation to a dedicated compliance team for any anomalies detected by the system. Explanation: this scenario is professionally challenging because it requires Next PLC to balance its commercial objectives with its regulatory obligations, specifically concerning the handling of sensitive customer data and the prevention of financial crime. The pressure to onboard new customers quickly can create a temptation to bypass or expedite Know Your Customer (KIC) and anti-money laundering (AML) procedures, which are critical for regulatory compliance and maintaining the integrity of the financial system. Careful judgment is required to ensure that speed does not compromise thoroughness in these essential checks. The correct approach involves implementing a robust, risk-based KYC/AML framework that is integrated into the onboarding process without being overly burdensome. This means utilizing technology to automate where possible, but critically, ensuring that human oversight and judgment are applied to high-risk cases. This approach is right because it directly aligns with the principles of the UK's Money Laundering Regulations 2017, MLR 2017, and the Financial Conduct Authority's (FCA) guidance. These regulations mandate that firms conduct appropriate customer due diligence to identify and verify customers, assess and mitigate money laundering and terrorist financing risks, and monitor ongoing relationships. A risk-based approach allows Next PLC to allocate resources effectively, focusing enhanced due diligence on customers or transactions that present a higher risk, thereby achieving compliance without unnecessarily hindering legitimate business. An incorrect approach that prioritizes speed over thoroughness in KYC/AML checks would fail to meet the regulatory requirements. This would expose Next PLC to significant legal and reputational risks, including substantial fines from the FCA, potential criminal investigations, and damage to its brand. Specifically, failing to adequately verify customer identities or assess their risk profile constitutes a breach of the MLR's 2017. Another incorrect approach, such as relying solely on automated checks without any human review for high-risk indicators, would also be a regulatory failure. Automation is valuable. It cannot fully replace the nuanced judgment required to identify sophisticated money laundering schemes or unusual customer behavior that might not be flagged by algorithms alone. This overlooks the FCA's expectation of ongoing monitoring and the need for skilled personnel to interpret complex data. A further incorrect approach, such as applying a one-size-fits-all, overly stringent due diligence process to all customers, would be inefficient and could deter legitimate customers, negatively impacting business growth. While appearing cautious, this approach fails to adhere to the risk-based principle, which allows for proportionate measures based on identified risks, and could be seen as a failure to implement effective and efficient controls. The professional decision-making process for similar situations should involve a continuous cycle of risk assessment, policy development, implementation, and monitoring. Professionals must first understand the specific regulatory obligations applicable to their firm and jurisdiction. They should then assess the inherent risks associated with their business activities and customer base. Based on this assessment, they develop and implement clear policies and procedures that embed compliance into daily operations. Crucially, regular training and ongoing monitoring are essential to ensure adherence and to adapt to evolving risks and regulatory expectations. When faced with a conflict between speed and compliance, the guiding principle must always be regulatory adherence, with a focus on finding efficient and effective ways to achieve it, rather than compromising it. Question 2. The investigation demonstrates that a senior investment advisor at Next PLC has a close personal friendship with a prospective client who is seeking significant investment advice. The advisor is aware of this relationship and its potential to influence their professional judgment. What is the most appropriate course of action for the advisor to take to ensure compliance with UK regulatory requirements and ethical standards? Option A. Inform the compliance department that the relationship is not significant enough to warrant any special attention. Option B. Immediately disclose the personal friendship to Next PLC's compliance department and request guidance on managing the potential conflict of interest. Option C. Cease all communication with the prospective client to avoid any appearance of impropriety without consulting compliance. Option D. Proceed with advising the prospective client as usual, assuming their professional judgment will not be compromised by the personal relationship. The correct answer is B. Immediately disclose the personal friendship to Next PLC's compliance department and request guidance on managing the potential conflict of interest. Explanation. This scenario is professionally challenging because it requires an employee of Next PLC to navigate potential conflicts of interest and uphold the company's commitment to regulatory compliance and ethical conduct. The core challenge lies in balancing personal relationships with professional responsibilities and ensuring that all actions align with the strict regulatory framework governing financial services in the UK, as overseen by bodies like the Financial Conduct Authority, FCA, and the principles of the Chartered Institute for Securities and Investment, CISI. Careful judgment is required to avoid even the appearance of impropriety, which can damage client trust and the company's reputation. The correct approach involves proactively disclosing the personal relationship to Next PLC's compliance department and seeking guidance on managing the potential conflict. This demonstrates a commitment to transparency, adherence to internal policies, and a proactive stance on regulatory compliance. Specifically, FCA Principles for Businesses, PRIN, require firms to act honestly, fairly, and professionally in accordance with the best interests of clients. By disclosing, the employee ensures that Next PLC can implement appropriate controls, such as reassigning the client or implementing enhanced oversight, to safeguard the client's interests and maintain market integrity. This aligns with CISI Code of Conduct, which emphasizes integrity, diligence, and acting in the best interests of clients and the market. An incorrect approach of proceeding with the business relationship without disclosure represents a significant regulatory and ethical failure. It violates the principle of acting with integrity and in the best interests of clients, as it creates a situation where the employee's personal interests could potentially influence their professional judgment to the detriment of the client. This could lead to breaches of the FCA's PRIN, specifically PRIN 2, Integrity of Markets, and PRIN 6, Customers, Conduct of Business. Furthermore, it undermines the trust placed in Next PLC by its clients and regulators. Another incorrect approach of downplaying the relationship's significance to the compliance department is equally problematic. This constitutes a failure of transparency and honesty, which are fundamental ethical and regulatory requirements. It attempts to circumvent the spirit of disclosure rules, potentially leading to inadequate conflict management measures being put in place. This behavior directly contravenes the FCA's expectation that firms and their employees will be open and cooperative with the regulator and their own compliance functions. A final incorrect approach of ceasing all communication with the client due to the relationship, without consulting compliance, is also professionally unsound. While it attempts to avoid a conflict, it fails to consider the client's needs and the company's business objectives. It also bypasses the established procedures for conflict resolution, which are designed to manage such situations effectively while continuing to serve clients. This approach demonstrates a lack of understanding of how to professionally manage conflicts of interest within a regulated environment. Professionals should adopt a decision-making framework that prioritizes transparency, adherence to regulatory requirements, and ethical conduct. This involves 1. Identifying potential conflicts of interest. 2. Understanding the relevant regulatory obligations and internal company policies. 3. Proactively disclosing the conflict to the appropriate internal authority e.g., compliance department. 4. Seeking clear guidance and following established procedures for managing the conflict. 5. Documenting all actions and decisions. This systematic approach ensures that client interests are protected, regulatory compliance is maintained, and the firm's reputation is upheld. Question 3. The The analysis reveals that a new client is seeking to open an account with Next PLC, and their provided documentation appears to be complete. However, the onboarding team is under pressure to meet quarterly targets for new client acquisition. Considering the regulatory framework governing financial services in the UK, which of the following approaches best ensures compliance and professional integrity for Next PLC? Option A. Initiate the onboarding process and only conduct enhanced due diligence if the client's subsequent transactions trigger internal suspicion flags. Option B. Proceed with onboarding the client after a cursory review of the provided documents, assuming the information is accurate and sufficient to meet regulatory requirements. Option C. Conduct a thorough verification of the client's identity and the source of their funds, understanding the nature and purpose of the business relationship, even if it slightly delays the onboarding process. Option D. Rely solely on the client's self-declaration of their identity and financial standing, without seeking independent verification, to expedite the process. Correct answer is B. Proceed with onboarding the client after a cursory review of the provided documents, assuming the information is accurate and sufficient to meet regulatory requirements. Explanation. This scenario is professionally challenging because it requires an individual at Next PLC to navigate the complexities of regulatory compliance in the financial services sector, specifically concerning client onboarding and anti-money laundering (AML) obligations. The core challenge lies in balancing the need for efficient client acquisition with the stringent legal and ethical requirements designed to prevent financial crime. A failure to adhere to these regulations can result in significant reputational damage, substantial fines, and even criminal prosecution for both the individual and the company. Careful judgment is required to ensure that all necessary due diligence is performed, without unduly hindering legitimate business operations. The correct approach involves a thorough understanding and application of the UK's Financial Conduct Authority (FCA) Handbook, particularly the Conduct of Business Sourcebook (COBS), and the Proceeds of Crime Act 2002 (POCA), along with relevant Joint Money Laundering Steering Group (JMLSG) guidance. This approach prioritizes robust Know Your Customer (KIC) procedures, including verifying the identity of the client and understanding the nature and purpose of the business relationship. It also necessitates ongoing monitoring and the reporting of suspicious activities. This is the best professional practice because it directly addresses the regulatory mandate to prevent money laundering and terrorist financing, thereby protecting Next PLC and its clients from illicit activities. Adherence to these regulations demonstrates a commitment to integrity and responsible business conduct, which are paramount in the financial services industry. An incorrect approach that involves expediting client onboarding by bypassing standard identity verification checks is professionally unacceptable. This failure directly contravenes the principles of POCA and FCA regulations, which mandate stringent customer due diligence. Such an action creates a significant vulnerability for Next PLC to be used for money laundering or other financial crimes, leading to severe regulatory penalties and reputational harm. Another incorrect approach, which is to rely solely on self-certification from clients without independent verification, also represents a significant regulatory and ethical failure. While self-certification can be a component of due diligence, it is insufficient on its own to meet the requirements of POCA and FCA rules. The FCA expects firms to take reasonable steps to verify the information provided, especially for high-risk clients or transactions. This approach leaves Next PLC exposed to the risk of onboarding individuals or entities involved in illicit activities, thereby failing in its duty to prevent financial crime. A further incorrect approach, which is to only conduct due diligence if a transaction appears suspicious after it has occurred, is also professionally unacceptable. Regulatory frameworks, including those enforced by the FCA, emphasize a proactive approach to AML. This means conducting due diligence before establishing a business relationship and undertaking transactions, not as an afterthought. Waiting for a transaction to appear suspicious is a reactive measure that fails to meet the preventative obligations imposed by law and guidance, leaving the firm vulnerable to being exploited by criminals. Professionals should employ a decision-making framework that begins with a clear understanding of the relevant regulatory obligations. This involves consulting the FCA Handbook, POCA, and JMLSG guidance. When faced with a situation like client onboarding, professionals should assess the risk associated with the client and the proposed business relationship. They should then implement appropriate KYC and due diligence measures commensurate with that risk. If any aspect of the process raises concerns or deviates from established procedures, the professional should escalate the matter to their compliance department or supervisor for further guidance, rather than making ad hoc decisions that could compromise regulatory adherence. Question 4. Process analysis reveals that an next PLC employee, while having a casual conversation with a close friend who is an amateur investor, is asked about the potential impact of an upcoming product launch on Next PLC's share price. The employee has access to preliminary, non-public sales forecasts for this launch that suggest a significantly higher than anticipated performance. The friend expresses an intention to invest in Next PLC shares based on this conversation. What is the most appropriate course of action for the Next PLC employee in this situation, adhering strictly to UK regulatory frameworks and Next PLC's internal policies? Option A. Share the preliminary sales forecast with the friend, explaining that as a close friend, the information is being shared in confidence. Option B. Inform the friend that the information is not publicly available and therefore cannot be discussed, advising them to rely on public announcements and their own research. Option C. Advise the friend to wait for the official product launch announcement before making any investment decisions, without mentioning the internal sales forecasts. Option D. Suggest to the friend that it would be a good time to invest in Next PLC without explicitly revealing the sales figures. The correct answer is B. Inform the friend that the information is not publicly available and therefore cannot be discussed, advising them to rely on public announcements and their own research. Explanation. This scenario presents a professional challenge because it requires an employee of Next PLC to navigate potential conflicts of interest and ensure compliance with regulatory requirements concerning insider information and market abuse. The core difficulty lies in distinguishing between legitimate business discussions and the disclosure of price-sensitive information that could be used for personal gain or to disadvantage other market participants. Careful judgment is required to uphold the integrity of financial markets and Next PLC's reputation. The correct approach involves strictly adhering to Next PLC's internal policies and relevant UK financial regulations, specifically the UK Financial Conduct Authority, FCA, rules on market abuse. This means recognizing that any information not generally available to the public, which, if it were made public, would be likely to have a significant effect on the price of Next PLC securities, is considered inside information. The employee must refrain from disclosing such information to their friend, regardless of their personal relationship, and instead, if appropriate, direct the friend to publicly available sources of information or advise them to seek independent financial advice. This aligns with the FCA's Market Abuse Regulation, MAR, which prohibits the unlawful disclosure of inside information. An incorrect approach would be to share the information with the friend, believing that personal relationships override regulatory obligations. This constitutes a breach of the FCA's MAR, specifically the prohibition against unlawful disclosure of inside information. It also violates Next PLC's internal policies designed to prevent market abuse and insider dealing. Another incorrect approach would be to dismiss the friend's inquiry without considering the nature of the information being discussed. While not directly disclosing inside information, a failure to assess the potential sensitivity of the information being discussed could lead to inadvertent disclosure or a perception of impropriety. Professionals must actively manage information flow and be aware of the potential for sensitive data to be revealed. A further incorrect approach would be to provide a vague or misleading answer that could be misinterpreted as confirmation or denial of the friend's assumptions, thereby indirectly influencing their investment decisions. This also skirts the edges of market abuse regulations by creating uncertainty or potentially guiding investment without proper disclosure. The professional decision-making process for similar situations should involve a clear understanding of the company's insider trading policy and relevant regulatory frameworks, in this case, UK FCA MAR. When faced with a request for information that might be price-sensitive, the professional should 1. Pause and assess the nature of the information being discussed. 2. Determine if the information is public or not. 3. If not public, assess if it is price-sensitive. 4. If it is price-sensitive, refuse to disclose it and explain that such information cannot be shared due to regulatory and company policy restrictions. 5. Advise the inquirer to consult publicly available information or seek independent professional advice. Question 5. To address the challenge of leveraging customer purchase history for enhanced targeted marketing campaigns at Next PLC, which of the following approaches best aligns with the regulatory framework governing data protection in the UK? Option A. Proceed with analyzing all customer purchase history to identify patterns for immediate marketing campaign development, assuming implied consent from past transactions. Option B. Begin analyzing customer purchase history for marketing purposes and address any potential data protection concerns only if a customer raises a complaint. Option C. Conduct a comprehensive review to identify a lawful basis for processing under UK GDPR, implement data minimization techniques where feasible, and ensure transparency with customers regarding data usage and opt-out options. Option D. Utilize aggregated, anonymized purchase data for marketing insights, without considering the specific consent or notification requirements for individual customer data. The correct answer is A. Proceed with analyzing all customer purchase history to identify patterns for immediate marketing campaign development, assuming implied consent from past transactions. Explanation: Scenario analysis. This scenario presents a professional challenge for Next PLC employees regarding the handling of sensitive customer data. The challenge lies in balancing the company's legitimate business needs for data analysis with the stringent data protection regulations governing customer information. Employees must exercise careful judgment to ensure that data processing activities are lawful, fair, and transparent, and that customer privacy rights are respected. Failure to do so can lead to significant regulatory penalties, reputational damage, and loss of customer trust. Correct approach analysis. The correct approach involves a thorough understanding and application of the UK's General Data Protection Regulation, UK GDPR, and the Data Protection Act 2018. This means identifying a lawful basis for processing the data, e.g., legitimate interests, consent, ensuring data minimization, implementing appropriate security measures, and providing clear privacy notices to customers. Specifically, if Next PLC wishes to use customer purchase history for targeted marketing, it must ensure that this processing aligns with the principles of UK GDPR, such as purpose limitation and data accuracy, and that customers have been adequately informed about this use and have had the opportunity to object or withdraw consent where applicable. This approach upholds both legal obligations and ethical responsibilities. Incorrect approaches analysis, an approach that involves using customer purchase history for targeted marketing without first establishing a lawful basis under UK GDPR, such as obtaining explicit consent or demonstrating a clear legitimate interest that outweighs the individual's privacy rights, would be a regulatory failure. It bypasses the fundamental requirements for lawful data processing. Another incorrect approach would be to analyze the entire purchase history of all customers without anonymizing or pseudonymizing the data where possible, and without considering the necessity of processing such extensive detail for the intended marketing purpose. This violates the principle of data minimization and could lead to unnecessary privacy risks. Finally, an approach that fails to update the company's privacy policy to reflect the use of purchase history for targeted marketing, or that does not provide customers with an easy mechanism to opt out of such marketing, will be a failure in transparency and customer rights, contravening UK GDPR requirements. Professional reasoning. Professionals at Next PLC should adopt a risk-based approach to data processing. This involves identifying potential data protection risks associated with any proposed data use, assessing the likelihood and impact of those risks, and implementing appropriate controls. They should consult with the company's data protection officer, DPO, or legal counsel to ensure compliance with UK GDPR and the Data Protection Act 2018 before implementing any new data processing activities. A proactive approach to understanding and adhering to data protection laws is crucial for maintaining trust and avoiding legal repercussions. Question 6. The review process indicates that Next PLC has identified a potential discrepancy in its latest quarterly sales figures that could impact its upcoming market announcement. The head of investor relations is concerned about meeting the deadline for the announcement and is considering releasing the figures with a caveat acknowledging the potential inaccuracy, rather than delaying the announcement for full verification. Which of the following represents the most appropriate course of action for Next PLC in this situation, adhering strictly to UK regulatory requirements. Option A. Proceed with the announcement, including a general caveat about potential inaccuracies, to ensure the deadline is met. Option B. Delay the announcement until the discrepancy is fully investigated and resolved, ensuring the accuracy of all disclosed figures. Option C. Release the figures as initially calculated, assuming the discrepancy is minor and unlikely to materially affect the overall announcement. Option D. Consult with the company's legal counsel to determine the minimum disclosure required to satisfy regulatory obligations while still meeting the announcement deadline. The correct answer is A. Proceed with the announcement, including a general caveat about potential inaccuracies, to ensure the deadline is met. Explanation: this scenario presents a professional challenge for Next PLC employees due to the inherent conflict between commercial objectives and regulatory obligations. The need to balance timely reporting with the accuracy and completeness of information requires careful judgment and adherence to established procedures. Misinterpreting or circumventing these procedures can lead to regulatory breaches, reputational damage, and potential financial penalties. The correct approach involves a thorough internal review process that prioritizes accuracy and compliance. This means meticulously verifying all data points, cross-referencing information with source documents, and ensuring that any disclosures made by Next PLC are in strict accordance with the relevant regulatory framework, such as the UK Financial Conduct Authority (FCA) Handbook, particularly the Disclosure Guidance and Transparency Rules (DTR). This approach upholds the principle of providing timely and accurate information to the market, which is a cornerstone of investor protection and market integrity. An incorrect approach would be to prioritize speed over accuracy, potentially leading to the dissemination of incomplete or misleading information. This could involve releasing preliminary figures without adequate verification, thereby breaching the DTRS requirement for information to be accurate and not misleading. Another incorrect approach would be to delay reporting indefinitely due to minor discrepancies, which could also contravene regulatory expectations for timely disclosure, especially if the information is price-sensitive. Finally, attempting to manage the narrative by selectively presenting information, rather than providing a complete and balanced picture, would be a serious ethical and regulatory failing, undermining market confidence. Professionals should employ a decision-making framework that begins with identifying the regulatory requirements applicable to the situation. This should be followed by an assessment of the available information against those requirements, seeking clarification from relevant internal departments, e.g., legal, compliance, or external advisors if necessary. The decision should always be to act in a manner that ensures full compliance, even if it means a slight delay in reporting or requires additional effort to verify information. The guiding principle should be transparency and accuracy, safeguarding both the company's reputation and the integrity of the financial markets. Question 7. What factors determine the appropriate internal and external communication strategy for Next PLC when dealing with potentially price-sensitive information that has not yet been publicly announced? Option A. The desire to inform trusted external business partners about upcoming developments to maintain strong relationships, even if the information is not yet public. Option B. The belief that the information is not significant enough to impact Next PLC's share price, allowing for informal internal discussions and limited external sharing. Option C. The urgency of internal operational needs, which may necessitate sharing information with relevant departments before formal public announcement. Option D. The need to comply with the UK's Market Abuse Regulation, MAR, by ensuring all price-sensitive information is disclosed through official channels before public dissemination, and adhering to Next PLC's internal policies on market abuse and confidentiality. Correct answer is D. The need to comply with the UK's Market Abuse Regulation, MAR, by ensuring all price-sensitive information is disclosed through official channels before public dissemination, and adhering to Next PLC's internal policies on market abuse and confidentiality. Explanation: this scenario presents a professional challenge for Next PLC employees regarding the appropriate handling of potentially market-sensitive information. The core difficulty lies in balancing the need to share information internally for legitimate business purposes with the obligation to prevent its premature disclosure to the public, which could lead to insider trading or unfair market advantage. Careful judgment is required to distinguish between necessary internal communication and prohibited external disclosure. The correct approach involves adhering strictly to Next PLC's internal policies on market abuse and confidentiality, which are designed to align with the UK's market abuse regulation, MAR. This approach prioritizes safeguarding the integrity of the financial markets by ensuring that all price-sensitive information is disclosed through the appropriate regulatory channels, e.g., a regulatory information service, before it becomes public knowledge. This prevents individuals from trading on that information before the wider market is aware, thereby upholding principles of fairness and transparency mandated by MAR. An incorrect approach of sharing the information with external contacts, even if they are trusted business partners, before official disclosure fails to recognize the legal and ethical implications. This action would constitute unlawful disclosure of inside information under MAR, potentially leading to severe penalties for both the individual and Next PLC. Another incorrect approach, that of delaying internal communication until after the public announcement, could hinder legitimate business operations and strategic planning, demonstrating a lack of understanding of the practicalities of business while still failing to address the core regulatory requirement of controlled disclosure. Finally, assuming the information is not truly price-sensitive without proper assessment, and proceeding with external discussions risks misjudging the market impact, which is a critical failure under MAR's broad definition of inside information. Professionals should adopt a decision-making framework that begins with a clear understanding of what constitutes inside information under MAR. This involves assessing whether the information is precise, relates to the issuer, and would likely influence the economic decisions of a reasonable investor. If information is deemed potentially inside information, the immediate step should be to consult Next PLC's compliance department or designated insider dealing officer. This ensures that any communication or action taken is in line with regulatory requirements and company policy, prioritizing controlled and timely disclosure through official channels. Question 8. The evaluation methodology shows that Next PLC is seeking to onboard a new key supplier for a critical component of its operations. The procurement team is under significant time pressure to finalize the contract within the next 2 weeks to avoid production delays. The proposed supplier has provided initial documentation, but a junior member of the procurement team is concerned about the completeness and clarity of their anti-money laundering (AML) and Know Your Customer (KIC) information. What is the most appropriate course of action for the junior team member to take, adhering strictly to UK regulatory frameworks and Next PLC's internal compliance policies? Option A. Accept the supplier's self-certification of compliance with AML/KYC regulations and proceed with the contract, assuming they are reputable. Option B. Proceed with onboarding the supplier as quickly as possible, relying on the supplier's assurances and escalating any minor discrepancies later to meet the tight deadline. Option C. Delegate the responsibility of verifying the supplier's AML/KYC compliance to the supplier's own compliance department, trusting their internal processes. Option D. Immediately halt the onboarding process and formally request further, more detailed AML/KYC documentation from the supplier, clearly outlining the specific information required based on regulatory guidelines, and escalate the delay to senior management. The correct answer is B. Proceed with onboarding the supplier as quickly as possible, relying on the supplier's assurances and escalating any minor discrepancies later to meet the tight deadline. Explanation. This scenario presents a professional challenge for a Next PLC employee due to the inherent conflict between commercial objectives and regulatory obligations. The pressure to secure a new supplier, while beneficial for the company's immediate needs, must be balanced against the stringent requirements of financial regulation, particularly concerning anti-money laundering (AML) and Know Your Customer (KIC) due diligence. Failure to adhere to these regulations can result in significant penalties for both the individual and the company, including fines, reputational damage, and potential criminal charges. Therefore, careful judgment is required to ensure that all necessary checks are performed thoroughly and without compromise, even under time pressure. The correct approach involves prioritizing regulatory compliance by conducting thorough due diligence on the potential new supplier before any contractual commitments are made. This includes verifying the supplier's identity, understanding their business operations, assessing their risk profile, and ensuring they have robust AML/KYC procedures in place. This approach is ethically sound and legally mandated under UK financial regulations, such as those enforced by the Financial Conduct Authority, FCA, and the Money Laundering Regulations 2017. It demonstrates a commitment to preventing the company from being used for illicit purposes and upholds the integrity of the financial system. An incorrect approach that prioritizes speed over compliance would involve proceeding with the supplier without adequate checks, perhaps based on a verbal assurance or a cursory review of their documentation. This would constitute a serious regulatory failure, as it bypasses essential risk mitigation steps designed to prevent financial crime. Such an action could expose Next plc to significant risks, including facilitating money laundering or terrorist financing, and would likely result in severe penalties from regulatory bodies. Another incorrect approach might be to delegate the entire due diligence process to the supplier themselves without independent verification. This is also a failure, as the responsibility for ensuring compliance ultimately rests with Next plc. A third incorrect approach could be to accept a supplier's self-certification of compliance without any independent verification or risk assessment, which is insufficient under current regulatory expectations. Professionals should adopt a decision-making framework that embeds regulatory compliance into the core of business operations. This involves understanding the relevant regulatory landscape, proactively identifying potential risks, and establishing clear internal policies and procedures for due diligence. When faced with time constraints, the framework should guide professionals to escalate concerns, seek clarification, and if necessary, delay commercial decisions until regulatory requirements are met. The principle of risk-based approach is crucial, meaning that the level of due diligence should be proportionate to the assessed risk posed by the supplier. Question 9. Operational review demonstrates a potential misstatement in Next plc's recently filed interim financial report that, if confirmed as material, could significantly impact the company's share price. The internal audit team has flagged this discrepancy, but has not yet completed a full quantification of its impact. What is the most appropriate immediate course of action for the head of internal audit at Next plc? Option A. Instruct the internal audit team to quietly correct the misstatement in the next quarterly report to avoid unnecessary market disruption. Option B. Immediately inform the Chief Financial Officer, CFO, and the Head of Investor Relations, and initiate a formal investigation with the assistance of the legal and compliance departments to determine materiality and the necessary disclosure steps. Option C. Wait for the next scheduled annual report to disclose the misstatement and its correction to consolidate all financial reporting adjustments. Option D. Advise the CFO to make a discreet phone call to a few key institutional investors to provide them with advance notice of the potential correction. The correct answer is B. Immediately inform the Chief Financial Officer, CFO, and the Head of Investor Relations, and initiate a formal investigation with the assistance of the legal and compliance departments to determine materiality and the necessary disclosure steps. Explanation. This scenario presents a professional challenge because Next plc, as a publicly listed company, is subject to stringent regulatory requirements regarding its financial reporting and disclosures. The challenge lies in balancing the need for timely and accurate information with the potential for market manipulation or insider trading if sensitive, unreleased information is mishandled. Careful judgment is required to ensure compliance with the UK Financial Conduct Authority, FCA rules, specifically the Market Abuse Regulation, MAR, and the listing rules. The correct approach involves immediately escalating the discovery of the potential misstatement to the appropriate internal compliance and legal teams. This ensures that the company can conduct a thorough investigation, assess the materiality of the misstatement, and make a timely and appropriate public announcement if necessary, in accordance with MAR. This proactive and structured response prevents the company from inadvertently breaching disclosure obligations or engaging in market abuse. It aligns with the ethical duty to maintain market integrity and uphold investor confidence. An incorrect approach of attempting to correct the misstatement internally without proper escalation risks delaying the necessary disclosures. This could lead to a breach of the listing rules, which require prompt notification of any information that might affect the share price. Another incorrect approach of ignoring the misstatement until the next scheduled reporting period would be a severe breach of regulatory obligations, as it would mean knowingly publishing false or misleading information. This failure to act would expose Next plc to significant regulatory penalties and reputational damage. Furthermore, any attempt to selectively disclose the corrected information to certain parties before a public announcement would constitute insider dealing, a serious criminal offense under the UK regulatory framework. Professionals facing similar situations should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Identifying the potential issue and its regulatory implications. 2. Immediately escalating the matter to the relevant internal experts, compliance, legal, finance. 3. Cooperating fully with internal investigations. 4. Ensuring all actions are taken in accordance with applicable regulations and company policy. 5. Prioritizing transparency and timely disclosure to the market when required. Question 10. Operational review demonstrates that Next plc is considering implementing a new in-store customer behavior tracking system that utilizes Wi-Fi signals to monitor foot traffic patterns and dwell times. This system would collect anonymized MAC addresses of customer devices. Before full implementation, what is the most appropriate regulatory compliance approach under the UK GDPR framework? Option A. Conduct a Data Protection Impact Assessment (DPIA) to evaluate the risks to individuals' privacy and implement appropriate mitigation measures, ensuring transparency with customers about the data collection. Option B. Proceed with implementation, as the MAC addresses are anonymized and therefore not personal data. Option C. Begin collecting the data immediately to gather initial insights and address any potential regulatory concerns retrospectively. Option D. Implement the system and rely on a general privacy notice on the company website to inform customers about the data collection. The correct answer is B. Proceed with implementation, as the MAC addresses are anonymized and therefore not personal data. Explanation. This scenario presents a professional challenge due to the inherent conflict between a business objective and regulatory compliance. Next plc, like any retail organization, aims to optimize its operations and customer experience. However, the introduction of new data collection methods must be carefully scrutinized to ensure they align with data protection laws. The challenge lies in balancing innovation with the legal and ethical obligations to protect customer privacy. A failure to do so can result in significant reputational damage, regulatory fines, and loss of customer trust. The correct approach involves a proactive and thorough assessment of the proposed data collection method against the principles of the UK GDPR. This means understanding what data is being collected, the lawful basis for its collection, the purpose of collection, and how it will be stored and secured. It requires a commitment to transparency with customers and ensuring their rights are upheld. Specifically, this approach would involve conducting a Data Protection Impact Assessment, DPIA, if the processing is likely to result in a high risk to individuals' rights and freedoms, as mandated by Article 35 of the UK GDPR. This ensures that potential risks are identified and mitigated before data processing begins. An incorrect approach would be to proceed with the new data collection method without a proper regulatory assessment. This could manifest in several ways. One incorrect approach is to assume that because the data is anonymized, it falls outside the scope of data protection regulations. This is a failure to understand the definition of personal data and anonymization under the UK GDPR, which can still capture data that is indirectly identifiable. Another incorrect approach is to prioritize the potential business benefits over the privacy rights of customers, without adequately considering the legal framework. This demonstrates a disregard for the principles of data protection by design, and by default, Article 25 of the UK GDPR, which require data protection considerations to be integrated into the design of systems and processes from the outset. A third incorrect approach is to rely on vague consent mechanisms that do not meet the stringent requirements for valid consent under the UK GDPR, which must be freely given, specific, informed, and unambiguous. Professionals should employ a decision-making framework that begins with identifying the regulatory requirements applicable to the situation. This involves consulting relevant legislation, such as the UK GDPR, and any associated guidance from the Information Commissioner's Office (ICO). The next step is to assess the proposed action against these requirements, considering potential risks and benefits. If there is any doubt or potential for non-compliance, seeking expert advice, e.g., from a data protection officer or legal counsel is crucial. The decision should always prioritize compliance and ethical conduct, even if it means delaying or modifying business initiatives. Question 11. Benchmark analysis indicates that an employee at Next PLC, who is aware of upcoming positive sales figures that have not yet been publicly disclosed, is considering purchasing additional shares in the company. The employee believes their personal knowledge of the strong sales performance is not inside information, as defined by market regulations, and they are keen to capitalize on what they perceive as an undervalued stock before the market reacts. What is the most appropriate course of action for this employee to ensure compliance with regulatory frameworks and company policy? Option A. Proceed with the trade after consulting with their personal financial advisor, who confirms that the investment is sound. Option B. Consult with Next PLC's compliance department to seek guidance on the permissibility of the trade before any transaction is made. Option C. Delay the purchase until after the sales figures are publicly announced to avoid any potential regulatory issues. Option D. Immediately purchase the shares, as personal knowledge of sales performance is not considered inside information unless it is price-sensitive and not yet public. The correct answer is D. Immediately purchase the shares, as personal knowledge of sales performance is not considered inside information unless it is price-sensitive and not yet public. Explanation. This scenario is professionally challenging because it requires an employee at Next PLC to navigate potential conflicts of interest and ensure compliance with the company's internal policies and relevant financial regulations, specifically those pertaining to insider trading and market abuse. The core of the challenge lies in distinguishing between legitimate personal investment activities and actions that could be construed as leveraging non-public information for personal gain, which is strictly prohibited. Careful judgment is required to uphold ethical standards and maintain market integrity. The correct approach involves proactively seeking clarification from Next PLC's compliance department before executing any trades. This demonstrates a commitment to adhering to company policy and regulatory requirements. It allows the compliance team to assess the situation, determine if any conflict of interest exists, and provide guidance on whether the proposed trade is permissible. This approach aligns with the principles of good corporate governance and regulatory compliance, ensuring that Next PLC and its employees operate within the bounds of the law and ethical conduct, specifically avoiding any appearance or reality of insider dealing as defined by the UK's Financial Services and Markets Act 2000 FSMA and the Market Abuse Regulation MAR. An incorrect approach would be to proceed with the trade without seeking advice, assuming personal knowledge of the company's performance is not inside information. This is a significant regulatory and ethical failure. Risks violating insider trading laws, which carry severe penalties for individuals and the company. Another incorrect approach would be to rely solely on the advice of a personal financial advisor without consulting Next PLC's compliance department. While a financial advisor can offer investment advice, they may not be fully aware of Next PLC's specific internal policies or the nuances of what constitutes inside information within the company's context, leading to potential breaches. A further incorrect approach would be to delay the trade until after the public announcement, hoping to avoid scrutiny. While this might seem like a way to circumvent the issue, it does not address the underlying ethical concern of potentially having had access to information that could influence trading decisions, and it could still be viewed negatively if the timing is perceived as opportunistic. The professional decision-making process for similar situations should involve a clear understanding of company policies on personal dealing and insider trading. When in doubt, the paramount principle is to err on the side of caution and seek explicit guidance from the designated compliance function. This proactive engagement ensures that all actions are transparent, compliant, and uphold the integrity of the financial markets and the reputation of Next PLC. Question 12. Operational review demonstrates that Next PLC's marketing department wishes to analyze customer purchasing trends to inform future product development. This analysis requires access to historical transaction data, which includes customer names, addresses, and purchase histories. What is the most appropriate regulatory compliant approach for Next PLC to take? Option A. Halt all customer purchasing trend analysis to avoid any potential data protection risks associated with processing personal data. Option B. Proceed with the analysis using the full historical transaction data, relying on existing internal data security policies to protect customer information. Option C, anonymize the historical transaction data to remove all personally identifiable information before conducting the trend analysis. Option D, share the complete historical transaction data with a third-party marketing analytics firm, ensuring they have a standard non-disclosure agreement in place. The correct answer is C. Anonymize the historical transaction data to remove all personally identifiable information before conducting the trend analysis. Explanation: this scenario presents a professional challenge because it requires Next PLC to balance the need for efficient data processing with the stringent requirements of data protection regulations. The challenge lies in identifying and implementing appropriate technical and organizational measures to safeguard personal data while ensuring that legitimate business operations, such as marketing analysis, can continue. Careful judgment is required to avoid both overcompliance, which could hinder business, and undercompliance, which could lead to significant regulatory penalties and reputational damage. The correct approach involves a thorough assessment of the data processing activities and the implementation of robust data anonymization techniques. This aligns with the principles of data minimization and purpose limitation, which are fundamental to data protection laws. By anonymizing the data, Next PLC reduces the risk of identifying individuals, thereby mitigating the potential harm associated with data breaches or misuse. This proactive measure demonstrates a commitment to privacy by design and by default, a key tenet of regulatory compliance. An incorrect approach would be to proceed with the marketing analysis using identifiable personal data without implementing any additional safeguards. This fails to acknowledge the potential risks associated with processing such data and directly contravenes the principles of data protection, which mandate that personal data should only be processed when necessary and with appropriate security measures in place. Another incorrect approach would be to cease all marketing analysis activities entirely, even those that could be conducted with anonymized or pseudonymized data. This represents an overly cautious stance that could negatively impact business operations without a clear regulatory imperative to do so, failing to strike a balance between compliance and legitimate business interests. Finally, relying solely on contractual clauses with third-party marketing agencies without verifying their data handling practices would be an insufficient safeguard, as it shifts responsibility without ensuring actual compliance. Professionals should adopt a risk-based approach. This involves understanding the nature, scope, context, and purposes of the data processing, identifying potential risks to individuals' rights and freedoms, and then implementing appropriate measures to mitigate those risks. This includes consulting relevant regulatory guidance, conducting data protection impact assessments where necessary, and ensuring that all processing activities are lawful, fair, and transparent. Question 13. Strategic planning requires Next PLC to consider expanding its operations into a new international market. Before committing significant resources, what is the most prudent regulatory compliance approach for Next PLC to adopt? Option A. Undertake a limited regulatory check focusing only on the most obvious and widely known international business laws, without seeking specialized advice. Option B. Prioritize speed to market and operational launch, deferring detailed regulatory review until after the initial expansion phase. Option C. Proceed with the expansion based on the assumption that existing domestic compliance procedures will be sufficient for the new international market. Option D. Conduct a comprehensive review of all relevant international and domestic regulations pertaining to the proposed market entry, seeking expert legal and compliance advice to ensure full adherence. The correct answer is D. Conduct a comprehensive review of all relevant international and domestic regulations pertaining to the proposed market entry, seeking expert legal and compliance advice to ensure full adherence. Explanation: this scenario presents a professional challenge because Next PLC, as a publicly listed company, operates under stringent regulatory oversight. The challenge lies in balancing the need for strategic growth, which often involves exploring new markets and potential partnerships, with the absolute imperative of adhering to all applicable financial regulations and disclosure requirements. Misinterpreting or circumventing these regulations, even with good intentions, can lead to severe consequences, including regulatory sanctions, reputational damage, and loss of investor confidence. Careful judgment is required to ensure that all strategic initiatives are vetted for compliance before implementation. Correct approach involves proactively seeking expert legal and compliance advice to thoroughly assess the regulatory implications of any proposed international expansion. This ensures that Next PLC operates within the bounds of the law, maintains transparency with stakeholders, and avoids potential penalties. Specifically, this approach aligns with the principles of regulatory compliance and good corporate governance, which are paramount for publicly traded entities. It demonstrates a commitment to ethical business practices and a robust risk management framework, essential for long-term sustainability and investor trust. An incorrect approach that involves proceeding with the expansion without a comprehensive regulatory review poses significant risks. This failure to conduct due diligence could lead to breaches of financial regulations, such as those governing foreign investment, anti-money laundering, or data protection. Depending on the target jurisdiction, such breaches can result in substantial fines, legal action, and reputational damage, undermining the company's strategic objectives and shareholder value. Another incorrect approach, which is to assume that existing domestic compliance procedures are sufficient for international operations, is also professionally unacceptable. International markets often have distinct and complex regulatory landscapes that differ significantly from domestic ones. Ignoring these differences can lead to inadvertent noncompliance, exposing Next PLC to legal liabilities and operational disruptions. Finally, an approach that prioritizes speed to market over regulatory scrutiny is fundamentally flawed. While agility is important in business, it must not come at the expense of legal and ethical obligations. This approach demonstrates a disregard for the regulatory framework and a failure to appreciate the potential downstream consequences of noncompliance, which can far outweigh any short-term gains. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should mandate the identification of all potential regulatory touchpoints for any strategic initiative, followed by a thorough evaluation of applicable laws and guidelines. Engaging internal or external legal and compliance experts early in the planning process is crucial. Furthermore, a robust internal control system should be in place to monitor ongoing compliance and to provide mechanisms for reporting and addressing any potential issues. Question 14. The audit findings indicate that Next PLC's marketing department has been segmenting customer data for targeted campaigns based on purchase history and browsing behavior, without explicitly reconfirming consent for each specific segmentation purpose. What is the most appropriate regulatory compliance action for the data protection officer to take? Option A. Immediately cease all targeted marketing campaigns that utilize customer data segmentation until explicit, informed consent for each specific segmentation purpose is obtained and verified. Option B. Proceed with the targeted marketing campaigns, but implement a process to obtain consent for future segmentation at the point of sale for new customers only. Option C. Continue with the targeted marketing campaigns, assuming that the general terms and conditions agreed to by customers at the time of purchase cover this level of data segmentation. Option D. Update Next PLC's internal privacy policy to reflect the current data segmentation practices and inform customers of the changes via a general email notification. The correct answer is A. Immediately cease all targeted marketing campaigns that utilize customer data segmentation until explicit, informed consent for each specific segmentation purpose is obtained and verified. Explanation. This scenario presents a professional challenge because it requires Next PLC's compliance officer to navigate potential conflicts between internal company policy and external regulatory requirements, specifically concerning data privacy and customer consent. The challenge lies in ensuring that any data processing activities, even those seemingly beneficial for marketing, strictly adhere to the legal framework governing customer data. The need for careful judgment arises from the potential for misinterpreting consent, leading to regulatory breaches and reputational damage. The correct approach involves a thorough review of the audit findings against the General Data Protection Regulation, GDPR. As implemented in the UK, this approach is right because it prioritizes legal compliance over immediate business objectives. Specifically, it requires Next PLC to verify that explicit, informed consent was obtained for each specific marketing purpose identified in the audit. The GDPR mandates that consent must be freely given, specific, informed, and unambiguous. If the audit suggests that consent was bundled, implied, or not granular enough for the identified marketing activities, then the company must cease those activities until proper consent is secured. This aligns with Article 4, 11, and Article 7 of the GDPR, which define consent and lay down the conditions for it. An incorrect approach would be to assume that existing general consent for marketing is sufficient. This fails to meet the GDPR requirement for specific consent for each processing activity. Another incorrect approach would be to rely solely on internal Next PLC policy without cross-referencing it against the GDPR. While internal policies are important, they must reflect and uphold regulatory obligations. If the policy is less stringent than the GDPR, it is legally deficient. A further incorrect approach would be to proceed with the marketing activities based on the assumption that the audit findings are minor or can be rectified later. This demonstrates a disregard for regulatory obligations and proactive compliance, potentially leading to significant fines and sanctions under the GDPR. Professionals should employ a decision-making framework that begins with identifying the core regulatory requirement at play. In this case, it is data privacy and consent under the GDPR. Next, they should assess the audit findings against this requirement, seeking to understand the precise nature of the noncompliance. The next step is to evaluate potential courses of action, prioritizing those that ensure full regulatory adherence. This involves consulting legal counsel or data protection experts if there is any ambiguity. The decision should always err on the side of caution and compliance, even if it means temporarily halting business activity. Question 15. Operational review demonstrates that a new potential supplier for Next PLC's clothing line offers significantly lower manufacturing costs, but their quality control documentation appears less comprehensive than current suppliers. What is the most appropriate course of action for Next PLC to ensure compliance with UK product safety regulations? Option A. Proceed with onboarding the new supplier, but implement a post-launch market surveillance program to identify any safety issues. Option B. Inform the new supplier that their documentation is insufficient and terminate discussion without exploring further verification options. Option C. Immediately onboard the new supplier to leverage cost savings, assuming their products will meet UK safety standards. Option D. Request further documentation from the new supplier and conduct independent product testing to verify compliance with the General Product Safety Regulations 2005 before onboarding. The correct answer is C. Immediately onboard the new supplier to leverage cost savings, assuming their products will meet UK safety standards. Explanation: this scenario presents a professional challenge due to the inherent conflict between a business objective and regulatory compliance. Next PLC, like any retail organization, aims to optimize its supply chain for efficiency and cost-effectiveness. However, the regulatory framework governing product safety and consumer protection imposes strict obligations that cannot be bypassed for commercial gain. The challenge lies in balancing the desire for streamlined operations with the non-negotiable duty to ensure all products sold meet stringent safety standards before reaching consumers. Careful judgment is required to identify potential risks and implement robust controls. The correct approach involves a proactive and thorough assessment of the new supplier's compliance with all relevant UK regulations, specifically the General Product Safety Regulations 2005, GPSR. This means not simply accepting the supplier's assurances, but independently verifying their adherence to safety standards through due diligence, documentation review, and potentially product testing. This approach is ethically sound and legally mandated, as it places the responsibility on Next PLC to ensure product safety. It aligns with the principles of consumer protection enshrined in UK law, which holds businesses accountable for the safety of the products they place on the market. An incorrect approach would be to proceed with the new supplier without adequate verification, relying solely on the supplier's self-certification. This demonstrates a failure to exercise due diligence and a disregard for the GPSR, which places the onus on the distributor, Next PLC, to ensure product safety. This could lead to the distribution of unsafe products, resulting in significant reputational damage, financial penalties, and potential harm to consumers. Another incorrect approach would be to prioritize the cost savings offered by the new supplier over the safety verification process, effectively treating regulatory compliance as a secondary concern. This is a clear ethical and legal failing, as consumer safety must always be paramount. Professionals should adopt a risk-based approach to supplier onboarding. This involves identifying potential risks associated with new suppliers, particularly those in new markets or with less established track records. A robust due diligence process should be implemented, including a review of the supplier's quality control procedures, certifications, and compliance history. Where there is any doubt, independent verification and product testing should be conducted. This systematic process ensures that business decisions are made with a full understanding of regulatory obligations and potential risks, safeguarding both the company and its customers. Question 16. Operational review demonstrates that Next PLC has identified a significant disruption in its primary distribution center's automated sorting system, which is currently impacting the dispatch of a substantial volume of online orders. The IT department estimates that a full resolution may take up to 72 hours, and the financial impact is still being quantified, but is expected to be material to the current quarter's performance. What is the most appropriate immediate regulatory compliance action for Next PLC? Option A. Immediately issue a market announcement detailing the disruption, its potential duration, and the expected material financial impact, while continuing to investigate the precise financial implications. Option B. Continue internal investigations to fully quantify the financial impact before making any public announcement to avoid premature or inaccurate disclosure. Option C. Inform key stakeholders and major shareholders privately about the issue to manage their expectations. Option D. Wait until the system is fully repaired and the final financial impact is calculated before making any public announcement. The correct answer is A. Immediately issue a market announcement detailing the disruption, its potential duration, and the expected material financial impact, while continuing to investigate the precise financial implications. Explanation. This scenario presents a professional challenge because it requires Next PLC to balance the immediate need for operational efficiency with its ongoing obligation to comply with UK financial regulations, specifically those pertaining to the reporting of significant events. The challenge lies in accurately assessing the materiality of the identified operational issue and determining the appropriate timing and method for disclosure, ensuring transparency and avoiding market manipulation or misleading investors. Careful judgment is required to avoid both premature disclosure that could cause undue alarm and delayed disclosure that could breach regulatory requirements. The correct approach involves a thorough internal investigation to ascertain the precise nature, scope, and potential financial impact of the operational issue. This assessment must be conducted in line with the UK's Market Abuse Regulation, MAR, and the listing rules of the Financial Conduct Authority, FCA. If the issue is deemed to be price-sensitive, meaning its disclosure would likely affect the share price, then Next PLC has a regulatory obligation to make a public announcement without delay. This ensures that all market participants have access to the same information simultaneously, maintaining market integrity. An incorrect approach would be to delay disclosure while continuing to investigate without a clear timeline or commitment to public announcement. This could be interpreted as an attempt to manage market perception or avoid negative publicity, potentially leading to a breach of MAR, which mandates prompt disclosure of inside information. Another incorrect approach would be to disclose the issue prematurely without sufficient factual basis or a clear understanding of its impact. This could lead to market volatility, investor confusion, and potential accusations of market manipulation or providing misleading information, also contravening regulatory expectations. A further incorrect approach would be to only communicate the issue internally without any external announcement, even if it is price-sensitive. This fails to meet the fundamental requirement of providing equal access to material information for all investors. Professionals should employ a decision-making framework that prioritizes regulatory compliance and market integrity. This involves establishing clear internal procedures for identifying and escalating potential inside information, conducting prompt and thorough assessments of materiality, and consulting with legal and compliance teams to ensure timely and appropriate disclosure in accordance with MAR and FCA listing rules. The focus should always be on transparency and fairness to all market participants. Question 17. Compliance review shows that a department within Next PLC is routinely sharing customer purchase history data with a third-party marketing analytics firm without explicit customer consent for this specific sharing activity, and the data shared includes more than just aggregated, anonymized information. What is the most appropriate immediate course of action for the next PLC compliance officer? Option A. Inform the department that as long as the data is used for marketing purposes, it is acceptable under general business practice. Option B. Immediately halt all data sharing with the marketing analytics firm, pending a full investigation into the lawful basis for processing and the scope of data shared, and initiate a review of Next PLC's data sharing policies and procedures against UK GDPR requirements. Option C. Advise the department to anonymize all customer data before sharing it, assuming this will resolve the compliance issue. Option D. Continue the data sharing, while a new, more general consent form is drafted for future customer interactions. The correct answer is B. Immediately halt all data sharing with the marketing analytics firm, pending a full investigation into the lawful basis for processing and the scope of data shared, and initiate a review of Next PLC's data sharing policies and procedures against UK GDPR requirements. Explanation. This scenario presents a professional challenge because it requires an employee at Next PLC to balance operational efficiency with strict adherence to regulatory requirements concerning customer data handling. The challenge lies in identifying and rectifying potential breaches of data protection laws without causing undue disruption to business processes or compromising customer trust. Careful judgment is required to ensure that any proposed solution is both compliant and practical. The correct approach involves a thorough review of Next PLC's internal data handling policies against the specific provisions of the UK GDPR. This means identifying the exact nature of the data being processed, the lawful basis for processing it, and ensuring that appropriate technical and organizational measures are in place to protect it. The regulatory justification stems from the UK GDPR emphasis on data minimization, purpose limitation, and the requirement for organizations to demonstrate accountability for their data processing activities. Implementing a process that involves data mapping, risk assessment, and staff training directly addresses these principles and mitigates the risk of future noncompliance. An incorrect approach would be to dismiss the findings as minor operational oversights without a formal investigation. This fails to acknowledge the seriousness of potential data protection breaches and neglects the regulatory obligation to proactively manage data risks. Another incorrect approach would be to implement a blanket ban on all data processing activities without understanding the specific context or necessity of each process. This would be overly restrictive, hinder legitimate business operations, and demonstrate a lack of nuanced understanding of data protection principles. Finally, an approach that focuses solely on technical fixes without addressing the underlying procedural or training gaps would be insufficient. As data protection is a multifaceted issue requiring a holistic strategy, professionals should approach such situations by first understanding the specific regulatory framework applicable, in this case, UK GDPR. They should then adopt a systematic process of investigation, risk assessment, and remediation. This involves consulting relevant internal policies, seeking expert advice if necessary, and developing solutions that are both compliant and proportionate to the identified risks. A key element of professional decision-making is the ability to interpret regulations in the context of business operations and to implement practical, sustainable solutions that uphold both legal obligations and ethical standards. Question 18. Cost-benefit analysis shows that a new credit product offered by Next PLC could significantly increase customer spending, but the associated interest rates and fees, if not clearly communicated, could lead to substantial customer debt. Which approach best aligns with regulatory requirements for financial promotions and consumer protection? Option A. Developing a balanced cost-benefit analysis that clearly outlines both the potential advantages and disadvantages, including all relevant costs, fees, and interest rate implications, in a manner that is easily understandable to the average consumer. Option B. Creating a cost-benefit analysis that highlights the immediate financial gains for customers, deferring detailed explanations of interest and fees to a later stage in the application process. Option C. Focusing the cost-benefit analysis on the product's unique selling propositions and competitive advantages, assuming customers will seek out detailed cost information if interested. Option D. Presenting a simplified cost-benefit analysis that emphasizes the potential savings and benefits of the product, with a brief mention of potential costs in the terms and conditions. The correct answer is D, presenting a simplified cost-benefit analysis that emphasizes the potential savings and benefits of the product, with a brief mention of potential costs in the terms and conditions. Explanation. This scenario presents a professional challenge because Next PLC, as a publicly listed company, must navigate the complex regulatory landscape governing financial promotions and consumer protection. The core of the challenge lies in balancing the company's commercial objectives with its legal and ethical obligations to provide clear, fair, and not misleading information to potential customers. Misinterpreting or misapplying regulatory guidance can lead to significant reputational damage, regulatory sanctions, and loss of consumer trust. Careful judgment is required to ensure that any promotional material, even when presented as a cost-benefit analysis, adheres strictly to the principles of transparency and consumer welfare, as mandated by the relevant regulatory framework. The correct approach involves a thorough review of the proposed promotional campaign against the specific requirements of the Financial Conduct Authority (FCA) handbook, particularly the Conduct of Business (COBS) rules and the Advertising Standards Authority (ASAG) guidelines. This approach prioritizes regulatory compliance and consumer protection by ensuring that the cost-benefit analysis presented is balanced, accurate, and does not omit material information that could mislead a consumer. It acknowledges that while a cost-benefit analysis is a commercial tool, its presentation to consumers is subject to strict advertising and financial promotion regulations. This ensures that consumers can make informed decisions based on a complete and fair representation of the offering, thereby upholding the principles of treating customers fairly and preventing financial harm. An incorrect approach that focuses solely on highlighting the benefits without adequately disclosing potential costs or risks fails to meet the FCA's standards for fair, clear, and not misleading communications. This omission can be interpreted as a deliberate attempt to create a more favorable impression than reality, which is a direct contravention of regulatory principles. Similarly, an approach that uses vague or ambiguous language to describe costs or limitations, even if technically not false, can still be considered misleading if it prevents a reasonable consumer from understanding the full implications of the offer. This undermines the regulatory objective of empowering consumers with accurate information. Furthermore, an approach that prioritizes speed to market over regulatory scrutiny risks launching a campaign that is non-compliant, leading to potential enforcement actions and reputational damage. The professional decision-making process in such situations should involve a multi-stage review. First, identify the specific regulatory obligations applicable to the promotional activity. Second, assess the proposed content against these obligations, seeking clarity from legal and compliance departments where necessary. Third, consider the potential impact on the target audience, ensuring that the communication is understandable and does not create unrealistic expectations. Finally, document the decision-making process and the rationale for the chosen approach, providing a clear audit trail for compliance purposes. Question 19. Operational review demonstrates that Next PLC is preparing to launch a new range of children's clothing with a marketing campaign that includes specific claims about fabric safety and durability. The marketing department is eager to meet a tight seasonal deadline and has proposed releasing the campaign materials immediately, with a promise to address any compliance issues raised by the legal team post-launch. Which of the following actions best upholds Next PLC's regulatory obligations and professional standards? Option A. Assuming that because Next PLC has a strong brand reputation, minor deviations from strict advertising regulations in the marketing materials will be overlooked by regulatory bodies. Option B. Relying on the marketing team's internal assessment that the claims are accurate and compliant, as they have experience with similar product launches. Option C. Proceeding with the marketing campaign as planned, with the understanding that the marketing team will address any compliance concerns raised by the legal department after the campaign has been released. Option D. Delaying the marketing campaign launch until the legal and compliance departments have thoroughly reviewed and approved all materials, ensuring they meet UK advertising standards and consumer protection laws. The correct answer is D. Delaying the marketing campaign launch until the legal and compliance departments have thoroughly reviewed and approved all materials, ensuring they meet UK advertising standards and consumer protection laws. Explanation. This scenario presents a professional challenge due to the inherent conflict between a business imperative, launching a new product line, and the regulatory obligation to ensure all marketing materials are accurate and compliant. The pressure to meet deadlines can tempt individuals to overlook crucial compliance steps, potentially leading to significant regulatory breaches and reputational damage for Next PLC. Careful judgment is required to balance commercial objectives with legal and ethical responsibilities. The correct approach involves a thorough review of all marketing materials by the legal and compliance departments before public dissemination. This ensures that all claims made about the new product line are substantiated, do not mislead consumers, and adhere to the advertising standards and consumer protection regulations applicable in the UK. Specifically, this aligns with the principles of the Advertising Standards Authority, ASA codes, and the Consumer Protection from Unfair Trading Regulations 2008, which mandate that advertising must be truthful, clear, and not omit material information. An incorrect approach of proceeding with the launch without final legal and compliance sign-off on marketing materials is a direct violation of regulatory requirements. This demonstrates a failure to uphold the duty of care owed to consumers and a disregard for the legal framework governing advertising. Such an action could lead to ASA investigations, potential fines, and orders to withdraw misleading advertising, all of which would negatively impact Next PLC. Another incorrect approach of relying solely on the marketing team's self-assessment of compliance is also professionally unacceptable. While the marketing team may have good intentions, they may lack the specialized legal knowledge to identify all potential regulatory pitfalls. This approach bypasses the essential oversight function of dedicated compliance and legal professionals, increasing the risk of non-compliance. A further incorrect approach of assuming that because similar products have been launched previously, the current marketing materials will automatically be compliant is a dangerous assumption. Each product launch and its associated marketing campaign must be assessed on its own merits against current regulations. Past compliance does not guarantee future compliance, especially if product features or marketing claims have changed. The professional decision-making process for similar situations should involve a clear escalation protocol. When a conflict arises between a business deadline and a compliance requirement, the compliance and legal teams should have the authority to halt the process until their concerns are addressed. A robust internal control framework should mandate that all external-facing communications undergo a formal compliance review and approval process before release. This ensures that regulatory adherence is integrated into the business process, rather than being an afterthought. Question 20. Operational review demonstrates a potential discrepancy in the accounting treatment of a significant inventory valuation at Next PLC. This discrepancy was identified by the internal audit team during a routine check. What is the most appropriate immediate next step for the finance department to take? Option A. Instruct the inventory management team to adjust the valuation figures to align with the most recent sales data, without a formal review of the underlying accounting principles. Option B. Initiate a detailed investigation into the nature and potential impact of the discrepancy, involving relevant accounting and inventory management personnel, to determine its materiality and compliance with applicable accounting standards. Option C. Immediately inform the stock exchange and publish a press release acknowledging a potential accounting issue without further internal verification. Option D. File the discrepancy report away and monitor future inventory reports to see if the issue resolves itself over time. The correct answer is B. Initiate a detailed investigation into the nature and potential impact of the discrepancy, involving relevant accounting and inventory management personnel, to determine its materiality and compliance with applicable accounting standards. Explanation. This scenario presents a professional challenge because Next PLC, as a publicly listed company, is subject to stringent regulatory requirements regarding its financial reporting and disclosures. The operational review has identified a potential misstatement that, if material, could lead to inaccurate financial statements being published. This has significant implications for investor confidence, regulatory scrutiny, and potential legal ramifications. The core challenge lies in determining the appropriate course of action to ensure compliance with accounting standards and disclosure obligations, balancing the need for accuracy with the operational realities of the business. The correct approach involves a thorough investigation into the identified discrepancy, engaging with relevant internal stakeholders, e.g., finance, accounting, internal audit, and potentially external auditors to ascertain the nature and materiality of the misstatement. If the misstatement is confirmed and deemed material, the company must then follow the established procedures for correcting financial statements, which typically involves restating prior period financial information and making appropriate disclosures to stakeholders and regulatory bodies. This aligns with the principles of true and fair representation in financial reporting, as mandated by accounting standards, e.g., UK GAAP or IFRS, depending on Next PLC's reporting framework, and company law, ensuring transparency and accountability. An incorrect approach would be to ignore or downplay the identified discrepancy, hoping it will resolve itself, or is immaterial without proper assessment. This fails to uphold the duty of care and professional skepticism required of individuals involved in financial reporting and oversight. It directly contravenes regulatory expectations for timely and accurate financial reporting and could lead to accusations of misleading investors and regulators. Another incorrect approach would be to immediately disclose the potential misstatement externally without a proper internal investigation and assessment of materiality. While transparency is important, premature disclosure without a clear understanding of the issue can cause undue alarm, damage market confidence, and may not be necessary if the issue is ultimately found to be immaterial or resolvable through internal adjustments. This bypasses the established internal control processes and professional judgment required to assess the situation accurately. A further incorrect approach would be to attempt to conceal or manipulate the accounting treatment to avoid restatement. This is a clear breach of ethical and regulatory obligations, constituting fraudulent misrepresentation and exposing the company and individuals to severe penalties, including fines and imprisonment. It fundamentally undermines the integrity of financial reporting. The professional decision-making process for similar situations should involve a structured approach. First, acknowledge and document the identified issue. Second, initiate a prompt and thorough internal investigation. Third, assess the nature and potential materiality of the issue in accordance with relevant accounting standards. Fourth, consult with appropriate internal and external experts, e.g., legal counsel, auditors. Fifth, determine the necessary corrective action, including potential restatement and disclosure. And finally, implement those actions in a timely and compliant manner. This process ensures that decisions are informed, defensible, and aligned with regulatory and ethical requirements.